Brilliant, thank you. Well, good morning, everyone. Thank you very much for joining us on this week's instalment of Trending Treasury. Today, joined by Matthew Argent at Vanguard. Good morning, Matthew. How are you?
Good morning. I'm very well, thank you.
Thank you very much for joining us. You're going to talk us through ESG today, a massive and growing area of the market, and quite a difficult one to navigate, wouldn't you say?
Yes, definitely. I think it's an area that maybe throws up a lot of questions and maybe a lot of misconceptions as well. So hopefully today we can help demystify some of those areas.
Fantastic. Well, thank you very much for taking us through this topic. Yeah, the market has been growing quite a bit, hasn't it? It's sort of exponentially as various things come online, like the US. Various bills that they've got going on, and the market in general. Can you take us through a bit of that?
Yeah, of course. Well, yeah, the market really has grown a lot in sort of recent years, quite immensely, really. So let's sort of jump straight into the topic then, Stuart. So I'll just sort of quickly let everyone feast their eyes on the learning objectives. But what I'll do, maybe the best thing to answer, give you a bit of an overview of the ESG landscape. Now, we've all come across a lot of news reports around ESG investing, but I think as this slide demonstrates, it's not just about the attention grabbing headlines. So we can see here from 2014 to 2018, there's been this huge rise in ESG strategies that you alluded to. So a 68% rise, and you can see that regionally Europe leads the way, but as you mentioned, Stuart, it's closely followed by the US. Now at Vanguard, we very much expect this trend to continue. Why? Well, firstly, investors are much better informed about ESG, and there's a growing demand as awareness of issues like the environment increases. But most importantly, there's been significant regulatory changes as well, which I'll touch upon during this presentation. And I think it's worth bearing in mind that we do think of ESG as a new concept, but actually the first retail ethical fund, which is still available now, called the Pax World Fund, it was launched in 1971, and the main driving force behind this was Methodists who wanted to avoid profiting from the Vietnam War. So what is ESG investing? And I'm sure everyone on this call is going to know that ESG stands for environmental, social and governance. Now, the environment is going to include areas such as carbon emissions, energy efficiency and water scarcity. And a really famous case of poor ESG practice was in 2010 when BP's oil rig Deepwater Horizon, which was operating on the Gulf of Mexico, exploded and sank and resulted, unfortunately, in the death of 11 workers. Now, this was also the largest oil spill in the history of marine drilling operations. Now, on the subject of social, this covers workplace policies, labour standards and consumer privacy, which I think is becoming more and more salient at the moment. And the real sort of importance of the social aspects, if we think back to 2013 and the collapse of the Rana Plaza building in Bangladesh. Now the plaza housed 5 garment factories and the accident resulted in the deaths of 1,100 people. So we can see that these are extremely important issues that need to be addressed and thought about quite carefully. And finally, governance looks at themes like board structure, board compositions and executive compensation. And although maybe sort of on the face of it doesn't seem as pressing as the social or environmental issues, we saw how recently Wirecard collapsed when their attempt to hide billions of pounds of debt from their auditors were exposed. So governance is still a really crucial piece of this. And whereas it's maybe easier to define the acronym ESG, it's maybe much harder to define what ESG means to a particular investor, or indeed how a company is rated on ESG. So we're looking at a very subjective topic here, and this subjectivity is what means we need to ensure we fully understand ESG products and really how well they align to investors' goals. So we'll take a deeper look at the various strategies a bit later on in the presentation. But before I do that, I just want to maybe look at why there is so much emphasis on ESG in investment at the moment. And one of the real key drivers behind this is something that's maybe sort of dear to the hearts of all of us who work in financial services, and that's regulation. And this was kicked off back in 2015 when governments around the world agreed to sustainable development goals to guide global action on economic, social and environmental targets. Now, this was swiftly followed by 195 countries signing the Paris Agreement, in which they all committed to keep global warming below 2 degrees. Now, the European Commission then worked towards further legislation. So between 2016 and 2018, the European Commission hammered out a plan which resulted in the Sustainable Finance Package, and that aims to encourage capital flows towards more sustainable activities. Now, the Corporate Sustainability Reporting Directive is going to mean that ESG considerations will be required to be incorporated into, say, for example, advisors' investment processes. But for asset managers, it means there will be a huge focus on transparency and disclosure. So regulation aside, what do investors, why do they use, in a lot of cases, ESG products? Now here, we've provided really the sort of main reasons why investors choose ESG products. And the first one, obvious one really, is satisfying values and preferences. So this may be a religious belief. We mentioned sort of the Methodists earlier on in the presentation, or indeed a political belief. It could be about affecting meaningful change. And research here shows that some investors are prepared to sacrifice potential returns in order to affect that meaningful change. And next we have generating financial benefit. Now, does ESG investing generate more or less returns versus the market, or indeed more traditional investing? So we'll look at a recent study that Vanguard have done in this area a bit later on in the presentation. And finally, meeting legal requirements. Now, some countries in Europe already have ESG regulations governing pension schemes, and therefore it'll be interesting to see, bearing in mind things like Brexit, whether this will be brought over to the UK. Now, of course, anyone investing in ESG would probably want to meet all these objectives, but all of them come with trade-offs, and it's difficult to find a solution that really sort of completely satisfies all of these objectives at the same time. So we've looked at the key motivations behind ESG investing. Now, it might be an idea, I think, to take a look at some of the main approaches. And here they are. So you have ESG integration. So that's incorporating ESG into the traditional investment process. Portfolio screening, so looking at both negative and positive screening products. Ownership, where managers are looking to affect change within a firm through holding shares in a company. And finally, impact investing, where managers are actively trying to drive positive ESG impact through selectively allocating capital. Now, we'll look at each of these in a bit more detail over the coming slides. However, we're aware that these are open to different interpretations by different firms. So let's begin by having a look at really the most, I think, commonly used form of ESG, which is ESG integration. And the most widely used, but I think the least understood form of ESG investing. So many firms, and I'm sure many of the investment funds that your clients on this call are already using, which are not branded as ESG products, will already be integrating ESG within their processes. So this is where a fund manager will take into account the ESG practices of a stock in their analysis. And as you can see from this slide, this will be done along the traditional financial metrics that they're already using to analyze a stock. And whilst ESG factors are being considered in the overall security analysis process, this is more about the financial benefit than any overarching ESG principles. So in most cases, the analyst will look at both positive and negative ESG factors and how they could impact a stock share price. Therefore, it's perfectly possible that a firm with a low ESG rating could be included in a portfolio if the analyst deems that it would add value from a risk and return perspective. Now, conversely, some firms who may not have strong ESG credentials who do have strong ESG credentials, I apologise, may not make it into a portfolio if it's deemed they're not providing good risk and return profile for the fund. So to summarise, ESG integration, it's not necessarily about only investing in funds that have good ESG practices and ratings. It's rather how their ESG practices will impact the risk and return profile of a portfolio. So I think here it's important to ask your fund manager, look, what is your view on ESG integration? How do you use it? And I thought it'd be helpful if maybe I'll talk you through an example of ESG integration. So let's say we've got two analysts who are researching a banking stock. So we're in real rock and roll territory here. So analyst A, let's call him John. John's not employing an ESG integration into his research, and therefore he looks at the bank and he determines the current market price is fair. He adds it to the portfolio. Now, analyst B, let's call her Janet. Janet is employing ESG integration into her process, and she finds that governance practices and standards in the bank are poor, and this could mean there's a heightened risk of potential scandal in the future. So Janet uses this information to determine that the bank's market price is overvalued and excludes that position from her portfolio. Now, a few months down the line, the bank is suddenly hit by a corruption scandal, which substantially decreases its share price. John didn't consider any of the ESG factors, and as a result, the portfolio's performance takes a hit. While Janet did. She did use ESG factors and she added value simply by excluding the stock. Now, it's obviously a purely illustrative example, but it's one that highlights how ESG might work in practice and shows it's not necessarily about only investing in funds that have good ESG practices and ratings, but rather how those practices will impact the overall risk and return of the portfolio. So next, we'll have a look at portfolio screening. Now, when it comes to portfolio screening, there are two main methods. The first one is exclusionary, and this is also known as negative screening. So this excludes, or it might underweight securities based on a specific ESG criteria. And then you have inclusionary, which is known as positive screening. Now, this overweights or only purchases securities of companies with higher ESG ratings than industry peers. So to put this into context, many index funds will generally have an exclusionary screening process, whereas many active funds tend to employ inclusionary screening. So with exclusionary funds, they're transparent, as you know what they will exclude, as they'll use a rules-based methodology. So let's use an oil company as an example. If the rules-based methodology is screening out oil companies, then it's removed completely. Exclusionary screening, therefore, it's less subjective, it's less open to interpretations, and it's more binary. So it's easier to understand and implement. It very much does what it says on the tin. If it says it'll avoid oil companies, it'll avoid oil companies. But the drawback to negative screening is, although you can get rid of the bad actors in the firms, you're not necessarily rewarding the good actors. So unfortunately, with exclusionary screening, there's no Oscars. When we look at inclusionary screening, you've got a lot more flexibility in how they screen companies, and they may look to own only the good actors. So this flexibility can also mean that this approach is less transparent, and therefore it's more difficult to understand. To implement an inclusionary screen, managers in this space, they might rely on some form of rating, whether one they've given internally, or they might use an external ratings agency to decide whether they include or overweight a particular stock. So let's take a look at why it's important to understand how different ratings agencies may view a particular company from an ESG perspective and what challenges managers may face when relying on these ratings. Now, just like how a stock analyst would rate a company as a buy, hold or sell based on their own specific criteria or findings, they can also apply the same process to give stocks an ESG rating. So they may refer to an ESG ratings agency or form their own opinion. And this leads us to a really important point. ESG rating methods can differ substantially from one agency to another. As of January 2020, there were 70 ESG ratings providers. All of them were applying different methodologies. On top of that, there are 65 different ESG categories. Now, we looked at some of the data collected by research affiliates who found that the quality of ESG ratings data can be deficient due to a lack of coverage or a dependency on self-reporting by companies. Now, this is often cited as one of the biggest barriers for investors who'd maybe like to enter the ESG space. And in addition, the methodologies used by ESG data providers are not consistent and can lead to drastically different outcomes when constructing a portfolio. So what I'd like to do right now is really try and bring this to life by using some stock examples and putting you in the shoes of an analyst doing some due diligence on companies. But we're going to do this with a bit of a twist, and Stuart's going to help me here because now it's time for Bruce's famous play your cards right game. So for the benefit of anyone on this call who's maybe younger than me, back in the 80s, long before we had Line of Duty, this was must-see weekend television, believe it or not. Now, the aim of this game is to use your knowledge of the following three companies I'm going to put up. They're all going to be well-known companies, to work out whether their ESG ratings are higher or lower than the previous one. So the ratings will range from 0, which is the lowest possible, to 1, which is the highest possible. So we're going to be going up in degrees of basis points. And the data we've used from this game has come from that report that I referenced earlier by research affiliates, which is a study looking at the differences in ESG ratings across 2 of the most prominent providers. So in the chat feature, what's going to happen is Stuart's going to put in higher or lower. If you could just like the higher or lower, depending on what you feel the answer is. So we're going to start off with Facebook. Now, Facebook are, of course, a technology company who derive the majority of their revenue from online advertising, but they also invest heavily in new products such as cryptocurrency, AI, and augmented reality. Now, Stuart, are we up and running?
We are up and running. Yes. So on the Q&A, please vote for whether you think Facebook is higher or lower than 0.5. Yeah, so it's an interesting one. It being a tech company, I would have thought it doesn't have a significant environmental impact. Facebook has had its the occasional governance scandal. So I'm going to go with it's probably lower than 0.5 there.
Lower than 0.5. Okay.
I see we've had a few votes so far. Seven votes for lower, 4 for higher. Going up. So I think general consensus is that 2/3 of people think Facebook is lower and about 1/3 higher.
Okay, so we're going lower than the average here of 0.5 or a 7. So interesting. So let's see what the 2 prominent ESG providers view this. And look, for those of you who said lower, well done, because according to these 2 ratings agencies, Facebook indeed has a lower ESG score than the median. But actually, if we look at these 2 figures, what's interesting is there's a fairly large difference between the 2 scores. So provider 1 gives Facebook a rating which is 45% higher than provider 2. So I thought it'd be interesting just to dig a little deeper at the individual E, S and G components that these 2 ratings providers have given to Facebook. So I'll bring that up now. And when we drill down to the underlying scores, you can see where this difference comes from. So There appears to be agreement from both providers when it comes to governance. However, looking at environmental and social, both providers actually disagree quite considerably. So if we take the environmental scores, the report from research affiliates found both providers had different categories for environmental issues, and how they measured these was a bit unclear. So, for example, provider 1 puts a 1/3 weight on management of environmental impacts from personal transportation. So I assume that's people driving to work. And it doesn't seem to be captured in any of provider 2's 16 categories. Provider 2 gives a large weight to operations incidents, which doesn't seem to be covered by provider 1 or 2. So we've got two data vendors here, including distinctly different sets of metrics to gauge the environmental characteristics of Facebook, assigning different weights and different evaluations for similar metrics, which results in Facebook being rated a top firm by one provider but below average by the other. So moving on, let's take the top score that Facebook achieved, which was 0.29, and move on to our next company. So who's it going to be? Apple. Now, I'm sure you all know Apple, designing, manufacturing and marketing mobile devices and computers, but how does it fare from an ESG standpoint from our two providers? So Stuart, what do you think? Apple more or less ESG than Facebook, higher or lower?
Well, I suspect that it will be slightly lower. Their environmental impact is probably quite significant. They extract various minerals, maybe not directly for their batteries and things like that, but I would imagine their governance is probably quite good. But yes, it'd be interesting to see the different providers, because clearly they have quite wide differences in how they assess each one. So I'm going to go with lower. We'll give a bit of an opportunity for people on the call to vote. I see they're voting. We've had 13 votes for higher and 3 for lower, so that's quite a consensus that it's higher.
Okay, so we're going for high then. Well, let's have a look. It's quite exciting, this, isn't it?
Yes,
right,
absolutely.
well, well done everyone who said higher, because according to our two ratings providers, Apple has higher ESG credentials than Facebook. So we can see here that actually both providers are given similar ratings of 0.41 and 0.43. Close, but not quite the same, which is just as well, because if anyone remembers this game on the TV, you get nothing for a pair, not in this game. But again, let's take a deeper dive at the individual E, S and G ratings that these two providers have given Apple. And when you drill down to the underlying ESG components, actually, although the headline figure is in broad agreement, you see less agreement with the scores. And they all vary quite considerably between the providers. So you've got to ask the question here, looking at this, is the correlation between the two scores more a result of luck than judgment? But again, let's take the highest score from Apple, which is 0.43, and let's have a look at our next company. And our next company is Wells Fargo. Now, Wells Fargo is an American multinational financial services company, headquartered in San Francisco. They've been in the press maybe for the wrong reasons in recent times, but how does it fare from an ESG standpoint? So using the highest score from Apple, which is 0.43, what do you think Wells Fargo rates in terms of ESG, higher or lower? So if everyone can place their bets now, please. Stuart, have you got any thoughts on this?
Well, from an environmental standpoint, I think it probably has a relatively low impact, and so has a good environmental score. As for social, possibly due to the recent scandals, maybe a slightly lower than and also for the governance as well. But there's quite a lot of regulation in the US, so I'm going to go with higher.
Higher, right. Should we ask the audience, Stuart?
Yes, absolutely. So we've had 7 votes for higher and 11 for lower, a bit more divided on this one than the previous ones. Yeah, it's fairly even, higher or lower, 10 to 12 at the moment. So yes,
okay, well,
even.
Just before I move on, then I will just say, if you're ever at an investment event and Wells Fargo, they have a stand, always go up to their stand, because they give away these lovely plush ponies. So just as an aside there, but let's have a look to see if Wells Fargo is higher or lower than Apple. Right, well done to everyone here, because you're all right. Provider 1 rates them highly, whereas provider 2 rates them lower. So no consensus here at all from the two providers. So, you know, when we sort of drill down, we can see that both providers rate Wells Fargo well from an environmental standpoint, actually, as you alluded to, Stuart, whereas the scores for social and governance are really, you know, just no correlation between them at all. So looking at the governance scores in particular, the report from Research Affiliates highlighted some really interesting differences. So provider 1 ranks Wells Fargo in the top third of governance in their universe, whereas provider 2 ranks it in the bottom 5%. And one of the biggest contributors to the ranking comes from a signed score of 0 on business ethics incidents by provider 2, which accounts for nearly 20% of the aggregate score calculation. So, you know, when it comes to ESG ratings, we can see from this game just how challenging it can be just to rely on one ratings provider or even draw comparisons between them. It does seem very subjective. So if you're using a fund where the manager is using an ESG ratings provider, it's important to consider which attributes have been chosen, how they're measured or weighted. So if you don't feel you've got the resource or time to look at the ratings that your inclusionary funds are using, you may favour an exclusionary fund that's easier to understand and transparent in its methodology. So unfortunately, this is the only game we've got in this presentation, but let's move on to our next ESG strategy, which is ownership. And when we look at ownership, investment stewardship is key. So to put simply, investment stewardship refers to engagement with public companies to promote practice that encourage long-term value creation for shareholders. The 3 key practices of a stewardship team are to advocate at industry groups, engage with corporate board members, and vote at company meetings. Now, interestingly, some of the more traditional investment funds that you're probably currently using that aren't branded as ESG could actually help satisfy certain investors' ESG requirements. And it's important to note that investment stewardship's primary objective is to work with company boards to reduce risk, which in many cases will improve outcomes from an ESG perspective, resulting in the potential for better returns for investors in the long term. And the biggest crossover area between investment stewardship and ESG are on the governance side, namely increasing the diversity of boards, scrutinising executive compensation and the overall corporate structure to ensure that boards and management serve the best interests of the companies that they represent. Now, it's usually the largest, most resourceful managers that have a dedicated investment stewardship program, and it's important to understand what these programs do, as they may be able to meet certain investors' ESG considerations. So the question here is, look, you know, would you rather own a bad company and try and influence them from a governance perspective from within, or would you rather be happier just excluding that company altogether and not having a voice for change? The difference to consider between an active and an index manager here is, whilst an active manager has the ability to effectively take the money off the table from a firm if they disagree with their principles, actually an index manager is always going to be at the table. So if you're constantly sat at the table, your voice is going to be heard, and it's harder for the board to ignore you. Now, it's up to you, firstly, to understand the firm's investment approach to ownership, and then decide whether you're better off having a seat at that table or just walking away and excluding the firm altogether. So now we'll take a look at the final ESG strategy, which is impact investing. Now, impact investing offers diverse and viable opportunities for investors to advance social and environmental solutions through investments that also produce financial returns. Therefore, there's dual objectives here. However, investors in this area are more likely to have a focus on creating a beneficial impact than being focused on superior returns. So there's 2 examples here on the right hand side. Now, the first one is investing in undervalued real estate, and the primary goal here is revitalising neighbourhoods. The second is investing in green energy, and the aim is to reduce carbon emissions. Now, in both cases, you can see that the environment and social impact is the primary objective. The investment objective is secondary, but actually it could still yield a good return. Now, what's interesting is there's a study from the Global Impact Investing Network, or GIN for short, which maybe isn't the best ESG acronym, but it's shown that the majority of impact funds are actually targeting market returns or below. 88% of investors said these returns, market or below, exceeded their financial expectations. So they were more than prepared to accept the trade-off between creating a positive impact and a financial return. And finally, ESG investing can be seen as having the most impact from an ESG perspective, but we really need to understand the trade-offs here, such as accessibility. A lot of these funds can be quite illiquid, cost implications, and the potential for lower investment returns. Now, we've covered the 4 broad ESG investing strategies now. So I just thought we'd go back to seeing how they can meet investors' ESG goals or motivations. And you'll be pleased to know we're coming to the final lap of the presentation now, but what we've done is we've looked to align the different ESG strategies to the different motivations that we talked about right at the start of this presentation. You can see the 4 strategies at the top and the 4 key motivations on the left-hand side. Although this is not Vanguard's corporate view, what I've done here is try and produce some guidance for you by adding weightings to each box to show you how likely is a particular strategy will align to an investor's ESG motivations. Now, due to the subjective nature of the weightings, it's impossible to find the perfect solution. And while screening ownership and impact investing are at least ticking all the motivation boxes, that is if you agree with the weightings, the differing weightings mean that there will need to be some trade-offs. So whilst you won't find the perfect solution, understanding the different strategies, how they align to clients' motivations, and considering other trade-offs such as accessibility, cost, and the potential return, you'll be able to find a strategy that has the right balance between investors' ESG motivations and the financial goals. So the important thing here is, let's not let the perfect be the enemy of the good. Now, we all know there's been a lot of discussion about whether ESG can harm or help your portfolio's risk-adjusted returns. And indeed, when we look at the short-term performance of ESG funds, there is actually a suggestion that ESG has had overall quite a positive impact. But at Vanguard, we've conducted a lot of research on this, and we've come up with some quite intriguing solutions. So here we've got all the different ESG styles of investment: index, active, exclusionary and non-exclusionary funds, and we've put these in over a 15-year period. And once we control for factors such as market, size, value, profitability and investment, we're left with the additional alpha that an ESG fund produces. And surprisingly, we found little dispersion in the results. So the alpha in the medium, which you can see at the top there, was centered around 0 across all samples and time periods. So it was neither positive or negative. In fact, even when you look at the full range at the bottom, there's still nothing statistically significant. And it's fair to say, I think ESG funds will give you a different journey from the wider market. In the majority of cases, we couldn't really say that the alpha of an ESG fund deviated from 0. And actually, this is good news if you think ESG comes with the price of negative returns. But it's maybe bad news if you're investing in ESG to improve overall performance. Now, it wouldn't be a Vanguard presentation if we didn't talk about cost. And although on the previous slide we've shown there's no provable correlation between ESG and increased returns versus the market, we can show there is a negative relationship between cost and alpha, and this still exists in ESG investing. And as represented by the green line for index and the red line for active, on average, decreasing the amount you pay for an ESG fund will increase the amount of alpha you generate. So you may be thinking, how do I find the right solution? Well, as a starting point, let's just conclude this by looking at it through an active an index lens. So to round this up, at the top you can see the 4 broad ESG approaches, and below what to consider when thinking about index and active ESG funds. So investment stewardship programs will run both across index and actively managed solutions, but they may vary depending on which firm you're using. With an index fund, the methodology tends to be rules-based, meaning look, it's very transparent, it's easy to understand, it does what it says on the tin. So funds in this space would generally be available at lower cost, maybe giving you a better chance of outperformance. Actively managed funds will offer more flexibility in their approach, but this may mean that the ESG methodology may not be as transparent and could vary over time. So it's important to consider while this flexibility may be seen as why you could have a better chance of outperforming, flexibility may mean that the fund's ESG considerations may not be fully aligned to an investor's motivations at any given point. So there we have it. I do hope this whistle-stop tour of ESG has been helpful for you all. I'll just let you feast your eyes on these learning outcomes, and I'll pass you back to Stuart.
Oh, thank you very much, Matthew. It's been very, very interesting. I think it's quite difficult for our clients. They've all got a different strategy at the moment. Actually, you know, there's ESG integration. Some might screen for different different funds. Yeah, it's a growing area that I think local authorities are really sort of looking to invest in and need to develop coherent policies, and that's something that you've helped outline here, and something that we at Arlen Close can also help with. I mean, we've got our ESG service, and if any clients on the call are interested in talking to us about ESG, please get in contact. We'll happily run through what we can do for you. Yeah, it's I think at the moment a lot of local authorities have declared a climate emergency and are looking at integrating ESG into their investment policies, and I think this has been very, very helpful. So thank you very much for joining us, Matthew, and we've sort of run over ever so slightly. So if anyone does have any follow-up questions, please pop us an email or pop it in the chat now, and we'll get back to you after the event. Thank you very much for joining us, and we'll see you all next week.
Thank you.